Hello, once again, David Moore with Equity Advantage with Robert Smith of Peregrine Private Capital, and we've sort of killed the topics of inflation and tangible assets. But if we start looking at tangible assets, I mean, the stuff that you sell, everything you sell is a tangible asset. What are you sort of looking at with respect to the tangible assets in a recessionary time? I mean, what's a segment of what you sell that is attractive that people should be looking at, and why during a time where we might have sort of a stumbling in the economy?
Well, we think it's a very, as we've already discussed, it's important at this point to be defensive, meaning maybe turn the switch off in your mind of how much money can I make, and turn the switch, how can I hold on to the money I've made on. And so it's a good time to get defensive. And if indeed one or more of these asset bubbles pop, that's going to be a major shock, and it's going to reverberate through the economy. And logically, when people experience shock or disruption, they tend to hunker down, okay? And hunkering down, I interpret hunkering down from a real estate standpoint as habitational assets, meaning if all of a sudden something dramatic happens from an economic standpoint, office buildings may become dispensable, retail may become under even more pressure, but the places that people live and or things associated with habitational assets should be of primary importance. So we've been emphasizing those, what we call habitational assets, as good defensive plays in anticipation against some kind of major downturn.
So we look at what you just said, and then, we're talking about the potential for recession, but if we look at this last crazy year and a half, or slightly more, the impact of COVID on different asset classes too. You mind making any comments you might have on that? As far as, and I'm throwing something out of nowhere, but I was just thinking while you were talking about, the habitational component there. Obviously, we've got a situation where for people, historically, I love doors. I'm a real estate guy. I always liked multifamily because we had diversified income. We had a stabilized asset. You got one rental house, you got one tenant. You got an apartment building, you might have 6, 8, 10, 50, 100, 200 tenants, right? And so you got to have a problem across a whole range of things to be a problem. But once again, if we're looking at certain states, I'm living in one of them where the tenants basically just, hey, you don't have to pay. And meanwhile, the property owner's having issues. So you're working in a different level. My people are going from typically the mom and pop giving up a few rental houses or multifamily or whatever it might be, and they're going into your assets, which are a totally different thing. But in that space, are there things that have fared better than others?
Well, the old saying, the proof is in the pudding. Certainly, COVID and the pandemic and the attendant lockdown that came in the wake of the pandemic was proof positive that habitational assets do extremely well. Meaning, the best performing asset in the pandemic and coming out of the pandemic, bar none, was self-storage, because self-storage has a tendency to do very well during periods of significant change. And COVID-19 and the unilateral shutdown of the economy by the government was a generational change. You had legions of people leaving school, leaving work, and they all had to have places to put stuff. And so that created a demand for self-storage. And then coming out, when people came out of lockup, you had, a year and a half's worth of pent-up demand for material goods. So and you had, Biden bucks being rained down on the economy. So you had people going out and buying everything under the sun, motorcycles, RVs, what have you. And so
you can't even
buy a bike these days. So once again, demand for storage led the way. So self-storage was a very, very solid asset class. Multifamily, even though we had and do we still have the continuing eviction moratorium, or has
I don't. Probably regional.
Probably regional.
Yeah.
That obviously had an impact on landlords' abilities to pay rents. That being said, at an institutional ownership level, our property providers, managers moved heaven and earth to make rents pay up to accommodate tenants to maintain an uninterrupted stream of rental income. They were very successful at doing that. Obviously, our occupancies didn't go down because no one had to leave. And actually, rents, it's interesting because of historically low interest rates and flooding the market with money. Obviously, there's more money out there than there are good places to put it, have been driving house prices sky high, outpacing most of people's ability to buy, which in turn has put even more pressure on rental properties. So where allowed, certainly not high tax, regulatorily burdened blue states, but in many red states, we're seeing very, very significant rent increases because people still can't afford housing. And they're also moving out to the burbs, and so there's demand there. So again, habitational assets did significantly better. Well, obviously, retail was already on the defensive pre-COVID-19 with e-commerce and Amazon, and COVID-19 pretty much put paid to that and hugely accelerated the online economy or movement to the virtual economy. And it goes without saying what happened to office buildings. So I think habitational assets did pretty damn well.
Interesting. Like the answer, habitational assets. Remember that. Thank you very much for joining us. We're going to come back in a couple minutes and talk about institutional investments and how they may be fair compared to privately owned, the mom and pop stuff too, during a hypothetically recessionary time.
Can do.
Yeah. So thank you once again for joining us. David Moore, Equity Advantage, Robert Smith, Peregrine Private Capital.
Thank you.
You didn't even realize